Every time you swipe your credit card, something invisible happens. It's not just a payment, it's a promise. In that moment, information travels across networks, banks communicate with each other, and trust is measured, verified, and sold, and you never even see it. You promise to pay people you will never meet, using money that doesn't even exist yet. And still, we call this freedom. We call it convenience. But what if this power to buy anything, anytime was really a system designed to control you? This tiny piece of plastic, lighter than a feather, has quietly changed how you live, how you spend, and even how you think. It didn't just change money, it changed you. Every time you swipe, tap, or click, you are part of one of the biggest psychological experiments ever conducted. To understand this, we need to go back before plastic existed. Before credit cards, credit was slow and local. People could only borrow from those they trusted. A shopkeeper might let a regular customer pay at the end of the month, or someone could borrow from a local lender. But the idea that millions of strangers could buy first and pay later, this was new and risky. The story of credit cards is about how trust, identity, and financial systems came together and how they eventually started to create problems. Credit has been around for thousands of years. In ancient civilizations, merchants recorded delayed payments and loans. In the modern industrial era, stores, hotels, and service providers started offering store credit to loyal customers. Early experiments with charge plates and local credit programs allowed people to buy now and settle later. By the mid-20th century, innovators created the first cards that could be used at multiple merchants, allowing broader and faster spending. The first universal card started small but grew quickly. They required full payment each month, but people loved the convenience. Soon after, banks began sending cards to thousands of households, even without explicit requests, testing mass adoption. Soon, networks emerged. Visa, MasterCard, American Express, and systems for authorization, fraud prevention, and dispute handling became essential. Rewards, promotional offers, and loyalty programs turned credit cards into powerful tools for consumer engagement. Technology advanced rapidly. Magnetic stripes replaced manual imprinters, and later chips and contactless payments arrived. But problems existed. People carrying large balances caused defaults. Merchants complained about fees. Regulators stepped in to protect consumers. Recessions exposed weaknesses. Complaints about hidden fees and aggressive marketing grew. Tensions built, creating systemic risks. As crises unfolded, banks tightened credit, rules changed, and markets consolidated. Alternatives appeared: subprime and secured card, co-branded cards, and later digital finance solutions. Buy now, pay later models repeated similar patterns, using behavioral psychology to encourage spending. Virtual cards, real-time credit scoring, and other digital tools helped reduce some risks, but the system's stress points remain. Education and financial literacy helped, but they could not fully solve the problem. Today, credit card usage continues to grow around the world. Millions of people rely on credit for daily expenses, online shopping, travel, and emergency. Debt levels rise when credit is easy to access. People carry balances that can quickly grow with interest and fees. Patterns repeat. Easy credit encourages spending, and debt problems follow. Credit cards also affect behavior. Minimum payment options trap people in long-term debt. Rewards, points, and buy now, pay later schemes encourage more spending. Paying with the card separates the pain of spending from the joy of buying. Hidden fees, teaser rates, and penalty interest often surprise users. The system is designed to profit from human psychology. From this history, 3 clear lessons emerge. First, convenience comes with hidden incentive. Credit cards feel like freedom, but they encourage spending and debt. Second, unchecked credit growth carries risk. Loose lending rules and high borrowing can create instability. Third, oversight and regulation must evolve. Financial products often move faster than laws, leaving people vulnerable. Plastic credit isn't going away, and maybe it shouldn't, but carelessness is dangerous. Assuming the system will correct itself ignores history. Each generation faces new debt traps rooted in past mistakes. As digital wallets and AI-driven finance become mainstream, the lessons from credit card history are more relevant than ever. Will we let people fall into invisible debt again? Or will we demand better design, smarter education, and stronger protections? If this story changed how you think about spending, share your experience, like this video, subscribe for more deep dives into money, finance, and power, and consider carefully how you use credit. A small piece of plastic may be thin, but its impact is massive.